They've done the unthinkable. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, there's no turning back now as they've set in motion the biggest crisis since the GFC. You're not going to believe what they did this time, and it's far worse than we could have even imagined. Plus, we're seeing demand crash in one of the most unexpected places. And we're also seeing a major issue show up for the U.S. labor market. And is the banking crisis only limited to the U.S.? Well, no, experts are saying another country is about to have some major problems with their banks as well. Plus, we have a sponsor for today's show, Vision Marine Technologies. You can find them on the NASDAQ under the symbol VMAR, and they want to put an electric outboard powertrain on every boat, and we want to show you how to put a potential 30% return in your trading account. Wait till you see this chart set up. Stay tuned to the end of the show or check out the pinned comment or description for more information. If you're wondering what we're doing at this hospital today, well, we took the show on the road since Dad just had his hip replaced. Just got word he's up in his room and doing well. So with that, let's over to Bloomberg, where we picked today's story up with the headline, China's economic recovery is losing momentum. And this is totally unexpected by the policymakers and political elites because they said that China was going to lead the recovery, that domestic demand was strong. We made the case that any upward momentum in the economic data was going to be quickly reversed. We're now seeing all the signs that point that the downturn for the global economy is about to take another leg lower. Those measures, together with the official data showing weak service sector growth and falling consumer prices in October, pointing towards deflation, implying the nation's consumption rebound struggled last month, even as Beijing announced more fiscal stimulus. And this is a really key point here because you think about, fiscal stimulus having just such turbocharged effect on an economy. We can look at what it did to the United States. The problem is it's not working in China. And one of the reasons it's not working is because they're the world's largest exporter. So they can stimulate domestic demand all they want, but in the end of the day, they're heavily reliant on what's going on in the rest of the world, and that is getting worse. China's leaders in July warned the world's second largest economy is following a pattern where short growth upturns are followed by downturns, just as we predicted would actually happen. And now let's take a look forward because China's credit data actually showed that corporate and household demand for long-term loans remained weak in October. And we talk about another issue here is in a debt-based economy, you need to see an expansion of debt. Of course, there's a particular type of debt that you actually really want to see, and China got the wrong kind. As we can see that government borrowing made up a record share of new financing, suggesting fiscal stimulus is a main economic support for now. And as we know, it's not going to work. It's not going to be enough because the issue isn't about domestic demand, which from China's perspective, they've got a ton of people. They should have plenty of demand. But the problem is they're looking outside to the rest of the world and saying, wait a minute, we shouldn't go spending because our jobs are based on what's going on outside of our country. And with PMIs disappointing and experts declined by more than expected, we think activity probably softened from September to October, a case that we've been making and Goldman economists are suggesting is actually true. And combined with signs of weaker housing and steel demand in early November, growth appears to be hitting a soft patch in the first half of the fourth quarter. So now we're hearing that word soft patch, which we're going to rewrite and say next big leg of the global downturn. And the evidence is pretty clear as China's credit growth still weak in October with low loan demand, not just a government issue here, but here we can see credit demand is still weak. Under the goal of lowering borrowing costs for the real economy and supporting domestic demand, there's still space for monetary policy to be stepped up. And what you're seeing now is a case where lower interest rates are not having effect. You're seeing that fiscal stimulus is not having effect. The economy there is still slowing, and that's putting a big threat at their property market, as we know, in addition to the banks. Because when the China's property market goes, and we know it's just a house of cards on the verge of collapse, the banking system there goes. And the problem here is that central bankers think that they have the magic wand, that they can just fix this problem. And this is also why when we see the Fed cut rates, you don't see an instantaneous reaction in the economy. But the challenge here is that loan growth is really critical in a debt-based economy. And what we're seeing in the U.S., as we're going to look at our data here in a moment, is the Fed should be cutting. And we're making the case why we're going to be chasing rates down to zero. And you're going to see there's going to be no effect in the economy because it's not a matter of an instantaneous response. Here you can see commercial industrial loans on a year-over-year rate of change, and this is in blue, now turning negative for the first time since the global financial crisis, this against the federal funds rate. And what I want you to see is that as lending decelerates, and you can turn to negative when it falls under that horizontal black line, what do we know? The Fed's already cutting rates. And the reason is simple, because the Fed figures out over time that higher interest rates do eventually slow credit growth. Of course, they're not doing it because it's just high interest rates. It's because money curves are inverted. And yet what you see is the Fed starts to reduce interest rates to spur growth. But look what happens every time. You can fast forward to the dot-com bubble. You see the deceleration in lending. Well, the Fed's cutting, and it doesn't slow it down because it's too little, too late. How about the global financial crisis? Same issue there. Now let's fast forward to where we're at now. And what do you see? Is the Fed is raising rates as lending is decelerating, and this is a massive problem because when this thing turns even deeper negative, what you're going to see is the U.S. economy completely outright collapse into a recession. The Fed's going to cut rates just like China did, and they're going to look back and say, wait a minute, it's not working. And one thing that's not working, well, are going to be more Americans, as we now see that holiday hiring demand is dropping off. And this is a warning signs for the job market. We've been making the case that this is coming in a big way as the number of seasonal positions publicly advertised this fall fell to the lowest level in a decade. This is according to Challenger Gray and Christmas. The National Retail Federation estimates that between 345,000 to 445,000 seasonal workers will be hired this year, down as much from a 40% from the recent high this posted back in 2022. So you look at what's going on. You have high inflation now. Households are looking for any extra income. They're going to perhaps want to pick up some seasonal work here to put some money in their pocket. And what they're going to find out is these jobs just aren't available. Those that do have jobs are likely to pick up some more overtime. But the issue here is you wonder why we're seeing continuing claims continue to elevate. It's because there just isn't the work this time of the year that we typically see. It's all because consumer demand is far less than the political elites want us to believe. The seasonal hiring slowdown comes alongside other signs that the labor market is downshifting. Overall job growth in October was half the prior month's gain, and the unemployment rate has risen half a percentage point since touching a multi-decade low in April. And now we turn to Germany and where we see potentially the next banking crisis happen. This, of course, will happen after what we see is coming for the U.S. And wait till you see the unthinkable. It's staggering what we actually did. You're going to look back and say, we learned absolutely nothing from the global financial crisis, and you want to see some regulation gone wrong? Well, you're going to see it here in a moment. But first, let's talk about Germany because they're warning that more commercial real estate pain is ahead. And the current troubles of commercial real estate investors and developers mean they will seek to sell more properties, extending the slump in the asset class. This is, of course, the case we make here in the U.S., that they're already getting rid of some of these underperforming properties. They're taking massive hits on it, but we're not seeing this transmit over to the bank balance sheets yet. They're not writing down the value of these properties on their books, and that's keeping the banks kind of just their nose above the waterline, because I'm going to show you the U.S. banks are still insolvent. But the matter of question now is what's going on in Germany, and could this be spreading across the rest of the world? And here we can see that the market, especially in office and in retail, will remain under a lot of pressure and result in losses for banks. Now, of course, what they want us to believe is that banks in Europe are actually far more solvent than here in the US, and they're well capitalized. But that's the case that you hear going into any recession or any financial crisis, is don't worry about the banks. And then what do we end up worrying about? Well, the banks, because that's usually the center of every financial crisis, comes to be that in a debt-based system, lower asset prices cause major pain for the banks, and Germany's not going to get out of this one. As commercial real estate has been one of the assets hit hardest by a rapid increase in interest rates as developers face a surge in borrowing costs, as well as shifts in behavior that started in the pandemic. The industry has also seen a drought of deals for over a year now, making it hard to know whether the values banks record on their loan book are accurate. And this is something we're making the case is true in the United States, that banks are not accurately valuing their buildings. They don't want to, because if they did and they came out in their earnings and said, look, we're going to write down our assets by 20%, 30%, maybe in some cases 50%, because we've shown you on the show where some of these buildings are transacting at extremely low prices. Could you imagine what would happen to the banks due to all the regulation they're under? They'd have to borrow an excessive amount from the Fed to stay solvent, or they just immediately go under. But nobody wants to see that happen. And the problem is, it's going to. And Branson said that while the developments in commercial real estate won't spark a crisis, well, don't worry, Branson, you've got that one wrong. They're absolutely going to spark a crisis, because it's going to be the center of the next crisis. Banks with higher exposures to the sector could face more difficulties, in an outright shocking statement, because they're absolutely going to face more difficulties. He didn't name any banks or real estate companies, probably for good reason, because if people knew the truth, well, then money would go flying out of those banks, and then you'd see another bank run, and what would happen is regulators and experts would be scratching their heads wondering, why did all this money leave these banks? It's because people know that when banks go insolvent, they don't want to rely on governments to pay out on their guarantees, nor do they want to find out that they had too much money there, and that's why we continue to see bank runs. But let's take a look at the U.S. banks before we get into what's going on in our headline story here, because it's going to blow you away. The U.S. banks continue to show signs of outright insolvency. Here are the Bank Term Funding Program. This is that program that the Fed set up, where the banks take their assets, such as their treasury securities, and exchange them for cash. And on a pretty high interest rate loan, what do we see last week? Banks taking even more money. So what is that telling us about the U.S. banking system? That the insolvency of these small and mid-sized banks is getting worse and not getting better. And so when we start to look at the broad picture here and see a slowdown in the global economy, we see issues in seasonal hiring in the U.S., it all tells us that the U.S. economy is going under. The banks are going to take a big hit, and wait till you see what they did. Now, let's over to the Wall Street Journal, where we get the clearest sign yet that commercial real estate is in trouble. And I know you're thinking, wait a minute, Steve, we understand that prices are coming down. We get it. Oh no, you have not seen what they actually did. This is something we just found out. The Wall Street Journal broke the story, and it is outright shocking of what the banks did, and you're not going to believe it, because lenders are issuing a record number of foreclosure notices related to risky property loans. You say, well, wait a minute. Commercial real estate isn't risky? Well, no, it isn't, because in the past, it generally doesn't go down in value, or if it does, it goes down a little bit, but it generally appreciates. And those loans aren't considered risky at all, unless, of course, they started writing risky loans, just like they did in the housing market back during the global financial crisis. And sure enough, lenders this year have issued a record number of foreclosure notices for high-risk property loans, this according to a Wall Street Journal analysis. Many of these loans are similar to second mortgages and are commonly known as mezzanine loans. And I know what you're thinking here. Wait a minute, this does start to sound like the global financial crisis, and it does, because you remember back then the banks were kind of limited. There was a lot of loans that were done with 80% down, but people for some reason were getting 100% qualification. How did they do that? Well, they went out to another lender and got the 20% down as a second or third mortgage or some combination thereof. And so they ended up borrowing 100%, in some cases more than 100% of the property. Well, now what we're finding out is the same thing just happened in the commercial real estate market, and it's everything to do with bad regulation. Mezzanine loans have high interest rates and offer a faster and easier path to foreclose on mortgages, which is great news. And what the Journal found out is 62 mezzanine loans and other high-risk loans this year through October. You might say that 62 doesn't sound very much, but that's more than double the number for all of last year and likely the highest total ever for a single year, as higher interest rates and rising vacancies punish the property sector. So what you're seeing here, and again, I want you to be thinking back to the global financial crisis where people were borrowing on their first mortgage and actually had a fairly decent rate, but in order to get the rest of the down payment, because they didn't have it, remember everyone was chasing higher property values, well, they borrowed on that second mortgage at a much higher rate, and in some cases, in many cases, on a variable rate loan. So when all interest rates went up, their payment went up. Well, in this case, these loans already came with a high interest rate loan. The issue here is now that rates are even higher, well, borrowers, they can't pay, and banks are taking them to foreclosure. And these loans took off during the decade following the 2008-9 financial crisis, no surprise, as regulators cracked down on big banks and it became more conservative lenders. So here you see the issue of regulation. The regulators came in and said, look, you big banks, you were at the center of the last crisis, and now we're going to make sure that you don't do that again. And the bank said, fine, we won't. The problem is other banks said they would. Many property owners made up the financing shortfall by borrowing from smaller banks. Again, you think back to these small and mid-sized regional banks here in the U.S., and you start looking at that bank term funding program, and you think, wait a minute, these banks are in dire shape. And if we knew how bad they were, well, you'd watch a big cash exodus, and these banks go under overnight. And so what they did is they took out second loans from debt funds and other non-bank lenders, often on top of bank mortgages. And lenders liked providing mezzanine debt because these loans generated higher yields, often more than 10% during the years when interest rates on long-term bonds hovered around 2%. So again, you see greed here playing a factor. It always does. They took on these high-risk loans under the notion that commercial real estate prices could never go down. Again, sounds just like the housing market during the financial crisis. The debt allowed investors to bid up prices while putting a little of their own money, inflating the commercial real estate leading up to 2022. And now real estate prices are falling, and many of these loans are in default. In the latest sign that regulators' efforts to shore up big banks after the 2008-9 crisis have created new trouble spots in property finance. And a lot of borrowers have basically said, quote, I can't hold this asset any longer, and I can't keep putting money in. And we said that would happen. And the lenders have said, fine, we're going to take it back. The problem is we know that these lenders, they can't handle these buildings. So it's not now just the fact that these buildings are coming down in value. We've got these high risk, high interest rate loans on the second, third, maybe even fourth position. And that, my friends, is going to be a big problem that we're all going to find out is going to impact these small and mid-sized lenders. And before rates started rising last year, mezzanine loans often came with interest rates of around 10 to 12% or more. Now these same loans often cost more than 15%, if you can imagine, and that makes it much harder to refinance when they expire, leading to more defaults and foreclosures. Mezzanine loans helped fund some large deals in the year leading up to 2008, and while there were fewer of these loans then, they often had many layers piled on top of each other. Things got so crazy, this according to Kenneth Chin, partner at the law firm. He said, I did a deal where there are 6 levels of mezzanine debt. If you can only imagine that how bad this is going to be when we find out that more and more of these commercial real estate properties start to go into foreclosure, there's going to be a massive amount of this mezzanine debt that goes under, and these small and mid-sized banks are going to absolutely crumble. And often loans added up to more than the value of the building. Well, there's a little surprise. Of course, we knew that would likely happen. And here we can see one of these village apartment complexes in Manhattan was taken over by lenders following the crash, had a whopping 11 layers of mezzanine debt, according to the property's bond prospectus. And many loans across the country were wiped out. when the market turned, of course, we know that exactly what would happen during the global financial crisis. A lot of those banks holding the second and third positions were completely wiped out. Now we know that a lot of these small and mid-sized lenders are holding that same amount of problem, and it's going to cause an even deeper crisis that many people don't see coming, including the experts, but we warned you. And now, but one thing we're super bullish on, that's our sponsor for today's show, Vision Marine Technologies, and you can find them under the NASDAQ, under the symbol VMAR. Let's take a look at what this company's doing, because they want to put an electric outboard powertrain on every boat, and what we want to do is show you, as we like to do with all of our sponsors, how you could potentially trade their stock for a 30% return. Stay tuned here, because wait till you see this chart set up, and with any future news coming from this company, I think could be a huge catalyst to send their stock price skyrocketing. And their vision is to revolutionize boating with a transformative electric propulsion system that will become the core of all EVs on the water. If you can imagine, that would be huge business for, of course, our sponsor, Vision Marine. And let's take a look, because their transformative wave has arrived, and Vision Marine stands at the helm of this revolution, and you can stand at the helm of their stock price under the symbol VMAR on the NASDAQ, because we're seeing a push to electric as governments legislate the move from gas to electric, and the industry, this is a big thing, is committing to go all electric in the next 10 years. This is a big deal. And let's take a look at their stock price here, because it's got a beautiful setup. You can see it came crumbling down into the supply zone. And what's nice here is you've seen buyers step in, not just a couple days in a row, but you're seeing here a couple weeks, and now starting to push higher and break up. And what we know is that stocks trade between supply zones. You see buyers come in a certain area, and then it moves up to find out where those sellers previously were. But look at this. We're seeing the RSI. You're seeing momentum build nicely. You're seeing a positive cross and MACD building out of that negative territory as it comes up to the baseline, showing you a beautiful setup here that we think takes their price up 30% to get into that supply zone. And the difference between automotive EV and maritime EV is where the huge business opportunity lies, because boat manufacturers, well, they don't make their engines, and their propulsion system could end up in every single manufactured boat one day. You want to talk about a unique opportunity for rapid scale and focus just on the most profitable part of the boating industry that would send their stock price skyrocketing. And here we can zoom in to the 90-day chart, and what we see again is this beautiful bottoming pattern where buyers are coming in right around this $1.75 to $2 price range, and we think that could be the catalyst to send it up to $2.50 to $2.75, which would realize a 30% gain in their stock. And they have a vision, because they've got no debt. They've got a profitable and growing rental division. 23% is owned by insiders, directors, and officers. They're looking to be cash flow positive starting next year, and their first revenue from powertrains starting this year, giving them a market cap of about $40 million. And again, you can find them on the NASDAQ under the symbol VMAR. Let's take another look at their stock price here, because what we see is, again, this beautiful setup. You want to see a bottoming pattern, and there is that volume profile line, $1.94, price just at $2 as we went to record today. So you can see the buyers are stepping in here, and once they've accumulated all the shares, then you're going to see a rally up to retest that sell zone. There's your 30% price increase. And again, this is a $15.5 billion market, and you can see over 305,000 outboards were sold in 2022. If only 1% of them went electric, well, that would be massive revenue for our sponsor here. So check them out on the NASDAQ under symbol VMAR. And as always, with any company we feature on our show, be sure to do your own research before placing any trades. You're under no obligation to purchase their stock. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.